How do bonds work? The simplest explanation. Bonds. No, we aren't talking about secret agents or unbreakable ties. We're diving into the world of financial bonds. Ever wondered how they work? Why people rave about them? Or why they're often seen as the safe choice in the roller coaster world of investing? Buckle up, because we're about to embark on a thrilling journey to demystify the enigma of bonds. Bonds 101, the basics. Picture this. You lend your friend some money and they promise not only to pay you back after a certain time, but also give you a little extra as a thank you for your trust. That's essentially how bonds work. Governments, municipalities, or corporations issue bonds to raise funds, and in return they promise to pay you, the bondholder, periodic interest and then return your principal at the end of the bond's term. Interest, the magic word. When you buy a bond, you're promised a specific interest rate, often called the coupon rate. It's like getting a regular thank you gift for lending your money. For example, if you buy a $1,000 bond with a 5% annual coupon rate, you'll receive $50 every year. Sounds good, right? Maturity date, the end game. Every bond has an expiration date known as the maturity date. It's like setting a reminder on when your friend needs to pay you back that money that they borrowed. On this date, bond issuers return the bond's face value, ensuring you get back the principal amount you have invested. So, we've tackled the basics, but let's dig deeper. Bonds might seem straightforward, but there's a whole world of strategy and nuance behind these financial instruments. Bond prices, the seesaw effect. Did you know bond prices and interest rates are like two kids on a seesaw? When one goes up, the other goes down. If interest rates rise after you've bought a bond, its price might drop. But if they fall, your bond's price might soar. This is crucial if you're thinking of selling your bond before its maturity date. Types of bonds, a colorful spectrum. Not all bonds are created equal. There are government bonds deemed to be the safest since they're backed by Uncle Sam's treasury. Then there are municipal bonds issued by cities and states, often with tax-free interest. And let's not forget corporate bonds from businesses. The higher the risk, often the juicier the interest rate. Yield to maturity beyond the coupon. While the coupon rate tells you the interest the bond pays, the yield to maturity, YTM, gives you a fuller picture. It factors in the bond's price, its coupon rate, its maturity, and all of the time periods in between. It's like a GPS for bonds, helping you understand the real return you can expect. Bonds versus stocks, the tortoise and the hare. Ever heard of the fable of the tortoise and the hare? In the investing world, stocks are the hares, fast, unpredictable, with high rewards and high risks. Bonds are the tortoises, steady, reliable, and often less risky. A balanced portfolio often has both, giving investors both safety and growth potential. As we navigate further into the fascinating realm of bonds, you might wonder why these seemingly slow-paced instruments garner so much attention. Let's unwrap more layers of this financial enigma. Risks? Yes, bonds have them too. While bonds are often seen as safer than stocks, they aren't risk-free. There's credit risk, the danger that the bond issue might not be able to pay you back. Then there's interest rate risk. If rates rise, your bond's price could fall. Understanding these risks helps in making informed decisions. Bond ladders, climbing smartly. Imagine creating a ladder with bond rungs that mature at different times, say 1 year, 2 year, 3 years, and so on. This strategy, known as bond laddering, helps spread out interest rate risk and ensures a regular inflow of cash as bonds mature. It's like having money rain down on you year after year. Bond ratings, the report cards. Just as students get grades, bonds get ratings. Agencies like Moody's or S&P give ratings based on how likely the issuer is to pay back. AAA is top-notch, while anything below BBB- might be a junk bond. Higher returns, but also higher risks. So always check a bond's report card. The big picture, why bonds matter. Whether you're a newbie investor or a seasoned pro, bonds offer stability, predictable returns, and a safety net. They can balance out the wilder swings of the stocks and provide a steady stream of income. As the saying goes, don't put all your eggs in one basket. Bonds ensure that your investment basket is both diversified and robust. And there we are at the end of our bond voyage. From their steady pace to their strategic importance, bonds play a pivotal role in the grand theater of investing. If this deep dive has illuminated the world of bonds for you, don't forget to like this video, and for more financial insights and adventures, subscribe to Wythdrawl Investing Insights. Remember, the world of investing is vast, but with the right knowledge, every challenge becomes an opportunity. Please consult a financial professional before making investment decisions. This is not to be construed as investment advice, and remember, past performance is not indicative of future results.